What's up everybody, Nate here, and throughout 2022 we have seen a startup and tech implosion, with some big brands like Amazon, Carvana, and Microsoft announcing a massive wave of layoffs. Now you're probably thinking, well Nate, that's just the tech startups and that's just a certain sector of the economy, but the problem is with a lot of these tech giants and a lot of these niches announcing layoffs, that could eventually bleed into the greater amount of our entire economy and leave some lasting effects. So today I want to talk about what is going on with these startups, how all of that is going to affect our economy into 2023, and why this startup problem may end up getting a whole lot worse next year. Startups in the United States are in a really interesting position because you got to think, when you are a startup, you're finally beginning your first business, and these businesses right off the bat don't have a lot of money. So what exactly can they do to kind of bring their product in front of a lot of people? Well, they can do one of two things. Startups have an opportunity to go out and try to make their own money and bring in their own marketing. That can get pretty expensive though, but this way you're kind of relying on your own financial stability. You're able to actually go out and create money and get profit, and that allows a lot of consumers to see you and continue to buy from your brand. Overall, this is a way for companies to basically do it themselves. They're able to go out and gather their own business, but this is also a much slower way to kind of build your business. Now, there is another way that startups can go about this. They don't necessarily have to use their own funds, and they don't have to take the slower route if they don't want to. Startups can actually go to venture capitalists or other private investors and try to gain funds from them. These venture capitalists and these investors are going to give them money that they can basically use for everything in their business. This has to go into production costs and for paying employees and of course for marketing. All of these things are really, really good for our economy too. They help build up every single aspect, because you got to think, as a lot of startups have grown over the last couple of years, that has helped our entire economy to grow too. Startups were then kind of pouring a lot of money into their employees. They were hiring a whole lot of people. You've probably seen videos on TikTok and on YouTube of people kind of going out and saying that startups and tech companies are the way to go right now. People can get that business and they can go in and be employed and make a whole lot more money very quickly. And at the end of the day, this made a lot of sense for tech startups in 2021 to go down this route. A lot of tech startups didn't take the route of doing everything themselves because it really didn't make a lot of sense to. There was so much money pumped into our economy and so much money kind of floating around that allowed startups to grow very quickly, and that allowed them to kind of have really big marketing budgets to kind of push up a lot of your other tech giants in advertising, and that kind of bled into creator funds here on YouTube and in a whole lot of other spaces. Now people were making a lot more money, advertisers were making more money, our entire economy was starting to grow. So that was kind of happening over the last couple of years. So you had startups kind of taking the opposite route, where now they were using VC funding, venture capitalists, and they were using private investors to fund their entire business. The problem is, in 2022, that money is no longer very easy to come by. The Federal Reserve has been raising their interest rates very quickly and aggressively all throughout this year, and that means that it's a lot harder for investors to take a risk on investing in startups that don't really make a profit and haven't really proven themselves just yet. They don't really have a really strong business model, and investors, with the federal funds rate now being at around 4% in the United States, can't simply just throw their money at any company that wants it anymore. So now all of these VC firms are kind of drawing back a little bit. We're actually starting to see money slowly start to dry up in that space, and just about every single space, because money is hard to come by and it's really difficult for these investors to take on a risk. Anything that they invest in has to come from their own pocket, and if they lose, then they're not going to be able to invest as much money into other things down the road. So with this money kind of hard to come by, you're starting to see investors both on Wall Street and in private markets and venture capitalists not pouring as much money into businesses. Now, companies like Amazon and Walmart have a lot of money on their own, but in order to grow and in order to kind of support their overinflated staffs, they need to have that that investor money. In 2021, a lot of companies hired a lot of people. Like I said before, it made a lot of sense to because there was so much money in our economy. The problem is they probably overpaid a lot of people, and now these people are not able to stay in these companies because they're draining the balance sheets of all of these startups and your big tech giants. Overall, Amazon and Microsoft and Carvana and all of these other tech companies now have to start cutting people, and they have to start laying off their staff. This also means, though, that what we're going to see into 2023 is a lot more companies cutting staff as the Federal Reserve continues to raise their interest rates. Right now, like I said before, the federal funds rate is around 4%. If it continues to go higher, if it goes into the 5% mark or the 6% mark, that means there's going to be a whole lot less money circulating throughout our economy. And with even less money, now you're going to have a situation where VC firms and these startups cannot survive. And that has a ton of implications for our broader economy, right? Because like I said before, you have a ton of these industries that are really closely connected. If you see a ton of startups lose their marketing because startups actually have to have a ton of marketing in order to grow as quickly as they do, now all of your other companies where that marketing existed are not going to get those ad dollars. We're talking about places like YouTube, and we're talking commercials for your major TV networks. So all of this money is about to disappear, and that's just from the startup side. Now VC firms are actually going to start pulling a lot of their money too, meaning a lot of your startups and a lot of your companies that are trying to grow are not going to grow as fast, and some are just not going to exist at all. That means that the United States could be in a situation where there's a lot less innovation and there's a lot less opportunities out there to create and grow businesses. That is exactly why in 2023 we are most likely going to see a lot of these startups start to fail. Not just in the crypto industry. I know there's a lot of things going on with FTX right now and BlockFi, and these exchanges have their own problems, but what I'm referring to is a lot bigger of an issue. We're starting to see liquidity crises for a lot of different companies, not just tech companies. Startups in general are losing money. They're not able to survive in these economic conditions because they chose a route that needs a lot of growth and needs a lot of money in order to survive. They don't have the sustainability from their own business model. So what we can expect from all of this going into 2023 is a lot more jobs to be lost from these tech companies and these startups. And we can also expect a lot of VC firms and private investors to no longer be funding startups in the future, which means startups are just not going to be able to start up, no pun intended, in 2023. We're going to see a whole lot less of them, and that trickles into other aspects of our economy like marketing and also the job sector. Everything that you can think of is going to be affected broadly by startups just not existing. They are a very important part of our economy, and small businesses are a huge part too. But that doesn't mean that we're going to see zero startups into 2023. There are always going to be businesses in the United States that need to be created because our entire economy is always growing, even if that growth is very slow, right? So we're always going to have needs. We're always going to need businesses to kind of fill in and be creative so that way we can have things. But as long as these startups that do launch over the next year or so are providing value and are kind of in an essential industry like food and clothing and energy, then they're going to be able to survive as long as they're doing something that meets a consumer's need. But startups just can't have an idea anymore. Venture capitalists and private investors are not going to invest in their company based on an idea. They need to be able to see that your business is going to make profits and that it's going to be sustainable and part of our country's long-term future. And that is going to still mean that startups play a very important role in our economy, although we most likely are going to see a ton of them flat out disappear in 2023. But that is it for me, everybody. Be kind out there, and I'll see you all in the next one.